بسم الله الرحمن الرحيم. السلام عليكم ورحمة الله وبركاته. Dear financial management students, we will start discussing chapter 14 in financial management course, which is talking about distributions to shareholders, dividends and repurchases. This chapter will cover the following topics: theories of investors' preferences, signaling effects, residual model, stock repurchases, stock dividends and stock splits, dividend reinvestment plans. This chapter focuses on the use of free cash flow for cash distributions to shareholders, and the main issues which is addressed in this chapter can be summarized by the following question: can a company increases its value through its choice of distribution policy? So could the company have the ability to increase its value through the level of distribution or the form of distribution, whether as a dividend or repurchases of a stock, and the stability of their distribution? The answer for this question will be at the end of this chapter. First, a company must have cash before it can make a cash distribution to shareholders. And the question here: what is the main sources of cash? The main sources of cash for any company, it could come from sale of an asset or from the company's internally activities or from its operating activities, after of course paying the interest and expenses and the taxes and the necessary amount for to be reinvested or invested in operating capital. So the free cash flow here for the firm, it could be coming from the sales revenue from the operating activities of the company, after deducting the operating costs and taxes and the interest, and also deducting the amount that it will be reinvested or invested in operating capital. Okay, and after that we will ask a second question: what is the uses of the free cash flow or the uses of cash? The cash could be used by the firm for paying interest on a loan, which could be taken from banks, or for paying the principal of the loans, or for paying dividends for shareholders, or for repurchases our stocks in the market, or for purchasing short-term investments. Of course, purchasing short-term investments, it will give a positive signal about the company, that it have the ability for using their free cash flow, whether the selling the short-term investment, it means that the company have a negative use of free cash flow. In our chapter we will focusing on the uses of free cash flow for paying dividends for shareholders and or stock repurchases. But the main question here, and it should be asked, how much to distribute in the form of dividends versus stock repurchases? And also this question, it will be answered at the end of this chapter. Okay, let's start with defining the distribution policy, whether a cash dividend or stock repurchases. So distribution doesn't mean only paying a cash dividend for shareholders. It could be repurchases our stocks in the market, and also the stability of the distribution, because if the company have the ability to paying a stable rate or amount of dividend for their investors or for their shareholders, it will give a positive sign for this company. Okay. After that we will talking about the theories of distributions the distributions pattern over the time. The percent of total payout as a percentage of net income has been stable around 26 to 28%. So the total amount of distribution 26 to 28%, but it doesn't mean that all of the percent it paid as a dividend or a repurchases. The dividend payout rates have fallen and the stock repurchases have increased. Over the time, the firms prefer to distribute their cash flow as a form of repurchase their stocks than to be paid as a dividend. Why? For simply because paying a dividend it will sometimes give negative signs about the company, that it couldn't have the ability to reinvest their money in an investment, or they doesn't have an idea to be reinvested. Repurchases now total more dollar in distribution than the dividend, and this is confirm what is said in the first point. A smaller percentage of companies now pay dividends. When young companies first making distributions, it is usually in the form of repurchases. So small companies or the young companies, firstly it is distribute their cash flow as a form of repurchases rather than to be paid as a dividend. So small percentage of the company paying as a dividend. What is the form of the company or the type of the company which has paid the dividend? Dividend payout have become more concentrated in a smaller number of large or mature firms. The firms that they have the ability to pay a dividend and paying this dividend with the same rate over a period of time. The small companies cannot do that. Why? Because this company, they are paying a dividend as a 1%, so this company should have the ability to pay the same rate over a period of time, but it cannot doing that, so the large or the mature firm can do it. This table shows the percentage of paying dividend or distribution cash flow as a form of dividend for several industries. For example, for software industries, they are paying 2.42% of their cash as a form of dividend, while the tobacco paying 1.69% as a dividend. So the type of industry, it will affect the ability of the firm to paying a dividend. Okay, let's start with the theories. Do investors prefer high or low payout ratio? There are 3 dividend theories. We will discuss each of them in more details. The first theory, dividends and irrelevant, investors don't care about payout. The second theory, dividend preference or paired in hand, investors prefer a high payout ratio. And the third one, the tax effect, the investors prefer a low payout. Let's start with the first theory, which is the dividend irrelevance theory. Investors are indifferent between dividends and retention generating capital gains. If they want cash, they cancel stock. If they don't want cash, they can use dividends to buy stock. Okay, so this theory, the authors argued that the firm's value is determined only by its earning and by the business risk. It means that the value of the company depends on the income produced, not how this income distributed or split between dividend and return earning. Okay, Okay, so but if the investors wanted to a dividend, so they can simply sell their stocks to generate cash, and if they don't want a cash, so they can use dividends to buy stock. Okay. Also, this theory implies the payout policy has no effect on a stock value or the required rate of return on a stock. The distribution policy or the payout policy have no effect on the stock value. Again, the authors of this theory argued that the value of the company or the stock price depends only on the income produced, not on the way that we are distributing this income, whether by dividend or return earning. Okay, this theory is based on unrealistic assumptions, no taxes or brokerage costs. Okay, the assumptions of this theory, it is argued that the companies or the firm are working on a perfect market. Perfect market, it means that there is no taxes paid or no brokerage costs will be incurred, and this is impossible in our life or on our market, financial market. If this assumptions is not true, then investors who want additional dividend must incur brokerage costs to sell shares and must pay taxes on any capital gains. So we are talking that this assumption is unrealistic. It is impossible to work in a market where there is no taxes paid or we are not paying brokerage costs. So if this assumption is not true, it means that the investors will paying taxes on a capital gains, or they will paying also brokerage costs in order to sell their shares. Okay, again, here we are talking that the investors can generate a cash by selling a stock, or if they don't want a cash, so they can using their dividend to be reinvested in the company. But selling stock, it means that the investors will incur costs. What is this type of cost? It is paying for a brokerage in order to selling our stocks. And what is the cost for reinvested? Paying taxes on the capital gains. Okay, so this theory is unrealistic, but it's still a theory of distribution policy. The second theory is dividend preference paired in the hand theory. Okay, investors might think dividends, the paired in the hand, are less risky than potential future capital gains. The investors might think that the dividends are less risky than the potential future capital gains. So the firms should pay a dividend. It will be better for me as an investor to hold my money today than to be reinvested and giving me the cash flow in the future. Okay, this theory argued that stock's risk declines as dividend increases. The return in the form of dividends is a sure thing, but return in the form of capital gains is risky. So shareholders prefer dividends and are willing to accept lower required return on equity. Okay, also high payout help reduce agency costs by depriving managers of cash to waste and causing managers to have more security by going to the external capital markets more often. Therefore, investors would value high payout firms more highly and would require a lower return to induce them to buy its stocks. Okay, to summarize this theory, it is easily the investors prefer to hold the money today in their hand. It is better than to be reinvested in the future. The return for the investors in the form of dividends is a sure thing, but the return in the form of capital gain is more risky. So it is better for the view of investors that the company pay the cash flow as a form of dividend rather than to be reinvested. Okay, the third theory of distribution policy, the tax effect theory. Low payout means higher capital gains. Capital gains taxes are deferred until they are realized, so they are taxed at a lower effective rate than dividends. First of all, there are two reasons why stock price appreciation still is taxed more favorably than dividend income. Okay, if we are reinvested our money than to be paid as a dividend, there are two reasons to be preferred, although there is a tax paid on this capital gains. The first reason, the increased stock price isn't taxable until the investors think to sell it, while dividend is taxed immediately. So if we are reinvested the cash flow which is paid by the company, so it will be taxed, but the dividend, because it's paid immediately, so it will be taxed immediately. And as you know, the dollar paid in the future has lower cost or effective cost than a dollar paid today because of the time value of money. The capital gains, it will anchor the investors to pay a tax, but this tax it will be paid in the future sooner than the dividend. The second reasons why we are preferred the cash flow to be reinvested or the capital gains than the dividend is if the stock still until the shareholders died, then no capital gains tax is due at all. So as we see, the dividend are in some cases taxed more highly than the capital gains. Investors might require a higher pre-tax rate on return and induce them to buy dividend paying stock. So at this theory we can summarize that the investors preferred the money to be reinvested again in the company as the capital gains, even if it is paid the tax, but this tax it will be paid in the future rather than to be paid as a dividend. Okay, what is or which theory is most correct? The first one or the second one or the third one? Some researchers suggest that high payout companies have higher required return on stock, supporting the tax effect hypothesis. So according to the third theory, the tax effect theory, some researchers said that high payout ratio have higher required return on stock. Payout companies have higher required return on stock. This is supporting the third theory, the tax effect theory. But other research using an international sample shows that in countries with poor investor protection, where agency costs are more severe, high payout companies are valued more highly than low payout companies. So according to other research point of view, they are think that from the investors' point of view, the companies that have a high payout ratio, it is valued more than the companies which is paid a lower payout ratio. Okay, empirical testing have produced mixed results. This empirical evidence in the book, it is very difficult to construct a perfect empirical text of relationship between the payout policy and the required rate of return on a stock. Why? First of all factors other than the distribution level should be held constant. Okay. The second reason is that the cost of equity should be measured with a high degree of accuracy. Okay, so in order to make an empirical evidence, first of all, we have to make our research or studies on companies or corporations have the same size, the same characteristics, and they are differ only on the distribution policy, and this is very difficult. And the second one is to calculating the cost of equity with a high degree of accuracy. So for these reasons it is very difficult to show the relationship between the payout policy and the required rate of return on the stock. There are other issues should be taken into considerations when we are discussing the distribution policy. Issues should be discussed when we are talking about the distribution policy. The clientele effect. What is the clientele effect? Different groups of investors or clienteles prefer different dividend policy. It means some of the investors preferred a high percentage rate of payout and others prefer a low payout ratio. So some stockholders want the firm to pay out a high percentage of its earning. Such investors are often in low or zero tax. So those investors who preferred the companies or the firms to pay a high percentage of payout ratio, they are assume that there is no taxes to be paid and there is no brokerage costs. On the other hand, the stockholders might prefer reinvestment because they have less need for current investment income. Those stockholders who need current income would be disadvantaged of the firm returns and reinvested income than paying dividend. And if they are wanted to sell these stocks, they will go to the trouble and paying more expenses of selling some of their shares to obtain a cash. So the stockholders who preferred a dividend, they will not be benefited from the firm returns and reinvested of those dividends, and if they are think to convert these stocks to cash, they will think to sell it, and if we are sell it, so we are incur more expenses as a brokerage costs and paying a tax. On the other hand, the stockholders who are saving rather than spending dividend, they favor low dividend policy. The less the firm pay out dividend, the less these stockholders will have to pay in current taxes. So the other shareholders who want to reinvest their money and not to be paid as a dividend, so they will prefer a low percentage to be paid as a dividend or a low dividend policy. Therefore, investors who want current investment income should own shares in high dividend payout firm, while the investors with no need for current investment income should own shares in low dividend payout firm. So the investors should search firstly for a firm which is confirmed with their preference. If you want a dividend or a high percentage of dividend or a high payout ratio, searching for firms who are paying a high dividend ratio, while if you are an investors who prefer a low dividend payout ratio and a high percentage of the cash flow to be reinvested, search for a firm with your preference. To that extent, the stakeholders can switch firm. A firm can change from one dividend payout policy to another, and then let the stakeholders who don't like the new policy sell to other investors who do. Okay, so the firm will apply new policy or new payout policy, and the stakeholders who don't wanna or don't like this new policy, they can sell their shares to the investors who like. However, this switching would be inefficient because of, first of all, increase the brokerage costs. Stockholders who are selling will have to pay capital gain tax, so it is increase the tax, and also a possible shortage of investors who don't like the newly dividend policy. So the firm will be fallen in a trouble because this is switching from one policy to another. It will increase the brokerage cost, increase the taxes, and also it will decrease the number of investors who don't like this new policy. For this reason, the management shouldn't change their dividend policy from one to another, even if there is a good reason for that, such as large number of investors who like this new policy. Then the high demand will reduce the costs and increase the stock price. We're talking about the distribution policy as the information content, signaling, and hypothesis. It is observed that an increase in the dividend is often accompanied by an increase in the price of stock, and that dividend cut generally lead to stock price to be declined. Some argued this as an indicator why the investors prefer dividend to capital gains. However, in the first theory, Modologini and Miller saw this differently. They are said that when a corporation cut a dividend, this implies a signal that the corporation don't raise dividend unless they anticipate higher earnings in the future, while when dividend reduction or smaller than expected increase, this is a signal that management is forecasting a poor earning in the future. So Modologini and Miller argued that investors' reactions to change in dividend policy don't necessarily shows that investors prefer dividend to return earning. Rather than they argue that the price changes following dividend actions simply indicate that there is important information or signaling or content in dividend announcement. However, more recent data with large samples shows that cut dividend had poor earnings in the years directly preceding the cut, but actually improved earning in subsequent years. So it appears that increase in dividends is a signal that past earning increases were not temporarily. Also, alternatively, a larger number of firms that expected a large permanent increase in cash flow do in fact increase their dividend payout in the year prior to cash flow increases. So the companies after the researchers implies that the companies who cut a dividend, it doesn't mean that they are predicted that their operating activities will be declined in the future. No, it implies that there is a poor earning in the years before or preceding the cut or this decreasing in the dividend. Dual model. This model will be used to determine the distribution ratio or the distributing amount or the payout ratio for the firms. Okay, when the firms decide how much cash to be distributed to shareholders, 2 points should be kept in mind. The first one is maximizing shareholder value, and this is the main objective of financial management. The second one, a company shouldn't retain income unless they sure that this will lead to returns higher than shareholders could earn by investing the cash in investment with equal risk. When establishing distribution policies, some firms produce a lot of cash but have limited investment opportunities. Such firms distribute a large percentage of their cash to shareholders as a dividend, while other firms generate little or no excess cash because they have many good ideas for invested this cash, and they have many opportunities. Such firms don't distribute much cash, thereby attracting investors who prefer capital gains. So we can summarize that for a given firm, the optimal distribution ratio is a function of 4 factors. The first factor, the investor's preference. The second one, firm's investment opportunities, whether the firm have an opportunity to invest, so they are reducing the payout ratio and increase the capital gains. The third one, the target capital structure. And the fourth one, the cost of external capital. When the cost of external capital is high, so the firm should think to use the internal source of financing from the equity in order to finance their investments. Under the residual distribution model, a firm follows 4 steps when establishing its target distribution ratio. First of all, it determines the optimal capital budget. Okay. Second, the amount of equity needed to finance the budget. The third one, it uses reinvested earning to meet the equity requirements. The fourth one, it pays the dividend or repurchases stock, which is referred to the residual, after supporting the capital budget. So it is an easy model. It is focused on 4 main steps. First of all, we have to determine what is our capital budget, what is our investment, what is our uses in the company, then what is the amount of equity needed to finance this capital budget, then by how much we will finance this budget from the equity, and the residual will be paid as a dividend. Okay, so to read the slide, find the reinvested earning needed for the capital budget, pay out any leftover earning, the residual, as either dividend or stock repurchases. This policy minimizes the flotation costs and equity signaling costs, hence minimizing the weighted average cost of capital. This is the steps for applying the residual model. Okay, this is the formula of residual model. Using residual model to calculate distribution paid, the distribution to be paid equal the total net income minus the total capital budget that we are needed to be invested, multiplied by the equity ratios which is in the firm. So by how much the capital budget can be financed from the equity, and the residual, it will be distributed as a dividend. So the distribution, it is equal to net income minus the required equity. Here is an example or application of the residual distribution approach. This is a data for a company. It is IWT company. This is given information about this company. Capital budget is equal to $112.5 million. The target capital structure is 20% debt and 80% as equity wanted to be maintained. Forecasted income or net income is equal to $140 million. Number of shares is 100 million. Okay, so the application for this firm. Number of shares as shown previously, it is 100 shares. Equity ratio as given 80%. The capital budget as given $112.5 million. The net income $140 million. Okay. The required equity, it is equal to the weight of the equity which is needed multiplied by the capital budget. So the equity ratio, it is equal, or we are financing our investment from equity by 80%. So 80% multiplied by the capital budget, it is equal the required equity, $90 million. So the distribution which is paid, it is equal the total net income minus the required equity, 140 minus the 90, it is equal $50 million. The payout ratio, in order to convert this value into ratio, it is equal the dividend divided by the net income, 50 divided by 140 million dollar, it is equal 35.7%, and dividend per share, it is equal to the total dividend to be paid divided by the total number of shares, $50 million divided by 100 shares, it is equal to $0.50 for every share. Okay, this column and this column, it is represent the same information but with a different number of net income. When the net income is decreased to $90, so this is the same amount of required equity because we have the same percentage of equity. There is no amount of money to be paid as a dividend. Okay, and what is when it is increased than the given number from $140 million to $160 million, the dividend per share increased to $0.7 per share. Okay, model, a fewer good investment would lead to smaller capital budget, so a higher dividend payout ratio. If the company doesn't have a good idea for an investment, so there's no need to hold the money in their hands, so they are paying out this dividend for the investors, while if they have a good investment ideas, this will lead to lower dividend payout ratio. What is the main advantages and disadvantages of the residual dividend policy? The advantages can be summarized as minimize new stock issues and flotation costs. If the company depends on their own equity in order to financing their investment, this will not lead the company to issuing new shares in order to financing the investments, so there is no issuing shares, so there is no flotation costs. Why? Because the company depends to financing their investments depends on the reinvested amount of cash flow. Disadvantages result in a variable dividends, so the dividends will be varied over the time, and this will send a conflicting signals to the investors, increase the risk, and doesn't appeal to any specific clientele. The conclusion, we can consider the residual policy when setting target payout ratio, but don't follow it rigidly. So we can use it for a specific period of time for 5 years, but it cannot be used forever. declaration date. On that date, the directors met and declared the regular dividend. For example, on 14th of November, this company declared that quarterly dividend of $0.50 per share to holder of record as December of 13th of December. Okay, the second date is the 10th of December. The dividends goes with stock. For example, if a person purchased 100 shares of this company at that date, so they can pay they can take a dividend in the payment date. The third date is the ex-dividend date. It is the date when the right to the dividend leave the stock. And the fourth one is the holder of record date. The company closes its stock transfer book and make up a list of shareholders as that date. And the last one is the payment date. For example, and the 3rd of January, the payment date to holders of record. Inshallah, we will stop here at slide 23, and next lecture we will continue. Thank you for your listening and good luck.